We have this document to explain share price appreciation, and you have two main categories: free cash flow per share growth and change in free cash flow yield. Let's start from the top. Free cash flow per share growth. For those who don't know what free cash flow means, that's the cash that the company generates at the end of the year, after the costs, after the inventory expenses, after the investments, after the capital expenditures. That's the cash that is remaining at the end of the year. And with this free cash flow, a company can do buybacks or pay dividends or pay down debt. So this is the cash at the end of the year. So that was for the free cash flow. And you see, this is not just free cash flow growth, it's free cash flow per share growth. We take into account the total number of shares from the company. And we will see this has an impact on the appreciation of a stock price over the long term. Okay, well, let's start from free cash flow growth. What can have an influence on free cash flow growth? First, revenue growth. So this is normal. If the business is growing, generating more revenue, more sales, for example, with higher prices, it will get more revenue. For example, Apple, if they raise the prices of iPhones, they will get more revenue. Very simple, very basic. So it's really easy to understand how revenue can grow, either with more volume or with higher prices. So that's for the revenue growth, the top line growth, because you start from a bigger amount of revenue, then you reduce the costs, the different margins, the capital allocation decisions, the investments. If you start from a bigger pie, you will get a bigger free cash flow. So that's the point of looking at revenue. If there is revenue acceleration, it is very likely that you will see free cash flow acceleration for a company. So in your analysis, if you want to have a free cash flow growing business, focus on businesses that grow their revenue. That could be the first layer of your analysis. And if you want to select the best investment ideas, you can run a screener and you put as a filter revenue growth. It doesn't mean that you need 20% revenue growth, but 5% per year, 8% per year, that's really decent. And the next thing for free cash flow growth is the free cash flow margin expansion. Cut costs, increase efficiency. Okay, what does it mean? What does the free cash flow margin mean? That's quite simple. Free cash flow divided by revenue. So if you generate $100 of revenue and you cut the costs, so you cut the salaries, the administrative costs, the inventory costs, the capital expenditures, the investments, at the end you get the free cash flow and you get $10 of free cash flow. So you take $10 divided by $100, you have a 10% free cash flow margin. So if for the next 5 years the free cash flow margin is improving, so instead of 10% you have 12, 13, 14, 15, you will generate more free cash flow. You will get more efficient compared to your operations. Less costs, more efficiency with AI, anything can work. So if you focus on businesses that improve the free cash flow margin, it will make your stock prices go up. That's a simple analysis, but it works. So if you get these two layers of analysis, first, revenue growth, so you start from a bigger pie, and more efficiency with free cash flow margin expansion, you have a very good recipe to have a strong long-term result for your stock. And for this analysis of free cash flow, I would advise to look at the past 5 years, past 10 years of a business. Look at the historical free cash flow growth. Don't look at 1 year, 2 years, 3 years, because of investments, short-term trends. These can fluctuate a lot within 1 year, 2 years. So look at 5 years, 10 years, and you will see the compound annual growth rate, the real growth rate of free cash flow growth. So for this part, don't look at the short term, look at the historical trends for the past 10 years. So that was for the free cash flow growth. We go down in this document to change in shares outstanding, so the total amount of shares that are available to the public. You have share issuance, stock-based compensation, and share buybacks. Okay, so the total number of shares for a public company can improve, so the company can create more shares with share issuance or stock-based compensation when the company pays employees with stock options, like little bonus to the management, free shares, additional shares that the company creates for management, for employees. So this adds to the total number of shares, okay? But you can get the reverse, reducing the total number of shares with the share buybacks. And let's look at the formula to get free cash flow per share. It's really simple. It's free cash flow divided by the total number of shares. So if you reduce the number of shares, if you do share buybacks, you improve your free cash flow per share. That's really simple. And there are companies that are experts of doing share buybacks. We call them the cannibals because they eat themselves every year. They buy back 3% of their shares, and then 3% next year, and then 3% the year after this. And over 10 years, 20 years, you get some beautiful numbers for the company because they bought back 50% of their shares. They bought back 80% of their shares. The most common examples for this situation are NVR, the home builder that has managed to buy back a lot of their shares and the stock price compounded beautifully. And the other famous example is AutoZone. Same category. They have decent free cash flow growth and an amazing share buyback program. So every year for the past decades, they bought back some shares and this increased free cash flow per share a lot. And this resulted in strong outperformance compared to the major indices, compared to the Dow Jones, to the S&P 500. And if you want to find the best investment opportunities, there is a link in the description below where I show my complete investing process, my complete method. So I explain how I generate great investment ideas, how I do my analysis, my valuation, and how I build a strong portfolio of great companies. There is a link in the description below. You can just click on it. That's completely free. So if we go back to the main document, the goal, what you want to see to improve the stock price is free cash flow growth, and you want a decrease in shares outstanding. And I'm not talking about 1 year, 2 years, I'm talking about long-term results. So in the next 5 years, 10 years, if a company manages to grow their free cash flow by 10% per year, and then they do buybacks, annual buybacks of 5% per year, you get two strong tailwinds that will boost your share price. That's two engines that are working simultaneously. So that was the big part, the biggest part, free cash flow per share growth. I hope that's clear. Okay, so now the second main category in this document is change in free cash flow yield. What does it mean? The free cash flow yield is the price to free cash flow but reversed. So for example, you have a company that has a stock price of $100 and they generate free cash flow, annual free cash flow of $10. So you divide 100 by 10, you get a price to free cash flow of 10. Okay, very well. Now you reverse the formula. So you divide $10 of free cash flow divided by $100 of the stock price and you get 10%. This is the same thing, it's just the way we name things in this field. You can talk about price to free cash flow or you can talk about free cash flow yield. In this document, that's free cash flow yield. So now you understand how it works. That's the reverse of price to free cash flow. So the big category is called change in free cash flow yield. Yeah, now we are going to talk about valuation. Valuation is maybe the most important part of investing. You can buy a beautiful business, a beautiful, growing, cash generative business that has strong tailwinds for the next 10 years. But if you buy too high, it will be a terrible investment. So valuation is the most important part of investing. Okay, now the first subsection is market sentiment, the view on the company and the view on the economy. These are two different views that can influence your stock price in the short term and in the long term. So let's start with view on the company. For example, the future growth or the competition. For example, a company can be in a competitive industry with a lot of disruptions, with a lot of startups that want to eat your lunch. If you are in this situation of having to fight every year to keep your market share, it's better to have a strong management. And if you are not strong enough, you will get eaten by competition. That's why they put competition in this image. Maybe competition will eat you and it will impact your growth, it will impact your margins, it will impact your free cash flow margin, for example, and it will impact the operations of your business. So competition has an impact on valuation. If you get eaten by competition, you deserve a discount in the stock market. The price of your stock will decrease. You deserve a lower valuation because you are an inferior business compared to competition that is growing nicely, profitably, etc. So competition definitely has an impact on valuation and your stock price. The second thing here is future growth. For example, if you have had a business that has been growing 15% per year for the next 10 years, okay, the market expects them to grow 15% per year for the next 10 years. Very well. Now, if management comes and says, okay, we are not going to grow 15%, but we are going to grow 9% because the market is already saturated and we are good with this growth. Let's play it safe. We are not aggressive now with the growth, but we'll play it safe for the shareholders. Okay, so how do you value a business that is growing only 9% per year instead of 15% per year? The valuation is not the same. The expectations for the stock investments are not the same. So it deserves a lower multiple. Say, for example, a stock was valued at a price to free cash flow of 25 when it was growing 15% per year. And if the management comes and says, okay, it's only 9% growth for the next 5 years, 10 years, it will go from a price to free cash flow of 25 to 15 maybe, because you can get better opportunities in the market. The stock market is about forecasts. It's about predictions, forecasting what the future will be in the next 3 years, 5 years, 10 years. And even us as investors, long-term investors, fundamental investors, we do a DCF. And in our DCF, we estimate a forecast of the next 5 years for the free cash flow. So we put our numbers in our table, and if instead of putting 15% growth, we put 9% growth, our formula will get a lower intrinsic value. So the investment will not be as good. So we want a lower price to buy the stock. So this has a psychological impact on every investor. Everything is interconnected. So if a company is slowing down, it deserves a lower multiple, a lower valuation. And valuation impacts the stock price. So if your valuation gets cut in half, the stock price will get cut in half. That's the harsh reality of the stock market. That's the way it works. So my advice here is not to pay a high price when you buy a stock. For example, the average PE ratio for the S&P 500 over many decades has been 15, 16. So you can say the average price to free cash flow, it's on overall this, around 15. So if you look at a business with a price to free cash flow of 35, you can say, wow, compared to historical averages, 35 compared to 15, that's really expensive. Maybe I will wait a little bit and not buy at this moment. The expectations are high. The opposite situation can totally happen. You get a strong business and for some reason it trades at 7 times free cash flow. So the price to free cash flow is 7. You can say compared to historical numbers, this is cheap and maybe this is a good time to buy. That was for the small valuation part. And the next point here for the subcategory is view on the economy. Inflation, recessions, crisis, everything that you can't control, we can't control, and that is not the main point of all our fundamental analysis. But still, if we enter a recession, it will impact our stock prices. So literally, we can't do anything about it. We just need to prepare. I would advise to not spend a lot of time anticipating the next recession or what will be the inflation data for the next 3 years. Nobody can predict it. Even Warren Buffett doesn't know how to predict it and doesn't predict it. So recessions will happen. And obviously, like in 2008, the big recession impacted share prices. Everything dropped 50%. Same thing for COVID. Everything dropped 30%. But still, nobody could predict that were going to happen. So I would advise to not spend a lot of time thinking about it. And the last point is market liquidity. That's the ability to invest. Interest rates, QE, so quantitative easing. So yeah, that's the monetary policy of the world, of the US most of the time. And this can influence your stock price. For example, in 2020, 2021, we had interest rates of 0%. So companies could borrow at near 0% to invest more in their operations, to boost growth. So they borrowed debt to have a lot of investments to boost their growth. And because they have more growth, they deserve a better valuation. And this is a change in free cash flow yield. And this increases the stock price. So yes, of course, interest rates have an impact on valuation. So that was for the situation with 0% interest rates. But if you increase the interest rates, like we've seen in 2022, when interest rates went from 0% to 5%, this had an impact on businesses. Because now when companies want to borrow, they don't borrow at 0%, they borrow at 5%. So they are less likely to borrow money to boost growth. So less borrowings, that leads to less investments in the business, less growth, and because of low growth, you get lower expectations and lower valuation. And lower valuation means the stock price drops. So of course, interest rates have an impact on valuation and stock prices. So you can get, there is a reverse correlation between interest rates and valuation. So if interest rates go up, stock prices go down. And if interest rates go down, stock prices go up. This is not true all the time, but this is a good approximation of how it works. And I'm telling you, nobody can predict how interest rates will evolve in the future. You can get some crazy moves, so I don't forecast what interest rates will look like in 5 years, 10 years. That's impossible because that's too many factors at the same time. I would not advise to focus on interest rates for your investments, but just know approximately how it works and you will be fine. And also QE, quantitative easing, which is part of the monetary policy of the Fed, the Federal Reserve. They inject liquidity in the financial system, which improves the global economy. You get more capital chasing after the same number of stocks. So that's supply and demand. And this creates a tailwind to stock prices that tend to go up when there is excess liquidity. So to sum up, I would say market liquidity at the bottom of this image and view on the economy, inflation, recessions, don't focus on this. Our goal as fundamental long-term investors is to buy great businesses. When you look at the economy or the market liquidity, interest rates, that's out of our control. We literally have no control over inflation, recessions. We cannot predict when the next global financial crisis will occur. What we can control is the price we pay. So that's the view of the company, market sentiment, future growth, competition with the free cash flow yield, the price to free cash flow. So you want to buy cheap. And we can also control the quality of the business, the free cash flow growth and the change in shares outstanding. So buy cheap and buy great businesses. That's the goal of this image. You want to buy the best companies at a cheap price. Investing is easy when you think like this. So if you use these key principles and you only buy companies that grow their free cash flow per share for the long term, and you buy them at a cheap price to free cash flow ratio, you are very likely to make money in the stock market. You will have stock prices that will go up in the long term. That's the key lesson for today. If you want to go deeper in your analysis, you have a link in your description below. Click on it. It's completely free and you will get a quick video where I will explain my complete investing strategy, the complete investing method that compounded at 24% per year for the past 7 years. So just click on the link and I'm sure you will like it a lot. You have another video over there. Don't forget to leave a like and subscribe for more videos like this. Okay, bye-bye.